Welcome back to the deep dive. Today, we're cutting right through the noise surrounding a name that constantly hits the headlines, but whose actual power and influence are, I think, often misunderstood. BlackRock, Inc.
It's a great topic because we're really grappling with a financial institution that has, in a way, ascended to a geopolitical scale.
Right.
The mission of this deep dive for you today is to cut through the mythology and understand the specific levers of control this company wields. We're talking everything from risk management software to, environmental policy.
Okay, let's just jump right in and try to grapple with the numbers because the scale is genuinely difficult to comprehend.
It really is.
Our sources confirm that as of 2025, BlackRock manages a mind-boggling $12.5 trillion in assets under management, AUM.
12.5 trillion. You almost have to just say the number a few times. Let that sink in.
It doesn't feel real.
It doesn't. To put that into perspective for you, this one company, this single entity, manages capital equivalent to more than 3/4 of the entire U.S. gross domestic product.
Wow.
And if you look back just 5 years ago, the combined assets of the so-called Big Three, that's BlackRock, Vanguard, and State Street, that totaled around 15 trillion.
And now BlackRock is almost there on its own.
Almost there by itself. This isn't just, a successful company. It's an unprecedented concentration of financial stewardship.
And that sheer, overwhelming size is exactly why it stopped being treated just as an investment firm. I mean, publications have dubbed it the world's largest shadow bank.
It's a loaded term.
It is, and its position is absolutely central to these intense, high-stakes debates that affect really every investor, every corporate board, and every national government. We're talking corporate governance, climate policy, and critically, national security.
So the big question we're trying to address for you today is this. What does the stewardship of that much capital actually mean in practice? How did they get this level of influence, and what are the specific, often contradictory controversies that pop up when one company has such a massive say over the global economy?
And not just the economy, but the energy transition, even government bailouts.
Exactly. We're diving into a comprehensive overview. They're unique, risk-obsessed origin, their often unseen technical backbone, which is a system called Aladdin, their rapid growth, and their deep, sometimes conflicted ties to governments and global markets.
So we've established the destination, $12.5 trillion. But how did a company founded in 1988 get here? It starts, funnily enough, with a failure, a multi-million-dollar mistake that ultimately became the firm's core competency. Let's dig into that origin story.
The founding narrative is absolutely the key to understanding BlackRock's DNA. It was launched in 1988 by 8 partners, including names you probably know, Larry Fink, Robert Capito, Susan Wagner.
Right.
But unlike most firms starting up in that era, which were all about maximizing returns, BlackRock's core mission was, it was unique. They wanted to provide institutional clients with asset management services, but always viewed through the lens of rigorous risk management.
And that focus wasn't just some abstract business school theory. It was intensely personal for Larry Fink.
It was.
The famous anecdote is that he had this devastating experience as the head of First Boston's bond department. He lost $90 million in the mortgage-backed securities market, all from a bad call on interest rates.
And that loss, that $90 million, it wasn't a failure that sidelined him. It was the crucible that forged BlackRock. It drove the partners to build the entire firm around this one singular principle of excellent risk management and fiduciary practices.
So they essentially reverse engineered a financial disaster.
That's a great way to put it. They decided that to truly succeed, they needed to be able to quantify and anticipate every possible risk their clients might face. That foundational fear, the fear of hidden risk, that's what built the empire.
So initially, they were actually a part of the Blackstone Group. They started with a $5 million credit line and were called Blackstone Financial Management at first.
Right. That early partnership with Stephen Schwarzman provided that crucial early backing. And it worked, it worked almost instantly. By 1989, their AUM had already quadrupled to $2.7 billion, mostly because they were so focused on managing risk in fixed income markets.
But that partnership, it quickly became a case study in corporate friction. By 1994, Fink wanted to reward new hires by giving them equity. He believed it was essential to lure top talent.
And Schwarzman at Blackstone, he resisted. He was not willing to dilute Blackstone's stake any further.
And that disagreement, which was purely about compensation and equity philosophy, led to the split. Fink and his team were sold, and they rebranded as BlackRock Financial Management. A pretty consequential decision.
Oh, absolutely. Schwartzman later famously admitted that selling BlackRock was a heroic mistake, especially given the stratospheric growth that followed. BlackRock went public in 1999, selling shares at $14 each. By the end of that same year, they were already managing $165 billion in assets. They had clearly evolved from just a niche risk management shop into a major financial player.
Okay, so that's the origin. Now let's move past the big AUM number, because the money is really just the result. We need to talk about how they actually operate, and that means diving into their tools and their massive products.
Well, when you're analyzing the financial landscape, BlackRock is one of what people call the Big Four index fund managers. That's alongside Vanguard, State Street, and Fidelity. They are completely central to the passive investing revolution that has swept the market over the last couple of decades.
Where investors just track broad indexes instead of trying to pick winning stocks.
Exactly. And the centerpiece of their passive dominance, the product that truly gave them the scale we see today, is iShares.
That name is everywhere.
The acquisition of iShares is, I think, arguably the single most decisive strategic move in BlackRock's entire history. They acquired this massive group of exchange-traded funds, ETFs, through the $13.5 billion acquisition of Barclays Global Investors, or BGI, back in 2010.
And this wasn't just about adding more assets to their pile, right? This is about buying market dominance in the fastest-growing investment segment out there.
Precisely. To quantify that dominance for you, by 2017, just 7 years after they bought it, iShares accounted for $1.41 trillion.
Wow.
That was 26% of their total AUM. But more tellingly, it accounted for a massive 37% of their base fee income. iShares became the engine for their revenue and cemented their, frankly, indispensable position in index investing globally.
Okay, but there's another piece to this puzzle. The true, often unseen source of their influence. The thing that gives BlackRock this almost infrastructural role in global finance. It's not the products they sell.
No, it's the proprietary software they use, Aladdin.
Aladdin,
Yeah.
an acronym, right?
It is. It stands for the Asset Liability and Debt and Derivative Investment Network. This platform is, well, it's legendary. It's often called the operating system of global finance.
That's a perfect description.
Aladdin grew directly out of Fink's initial obsession with risk management. It's this incredibly comprehensive platform that performs sophisticated risk management, investment analytics, and tracks portfolio exposure across everything: fixed income, equities, alternatives. It's the centralized brain that's constantly looking for the next $90 million loss before it can happen.
Okay, but here's where it gets really interesting for you, the listener. Aladdin doesn't just manage BlackRock's own $12.5 trillion.
Not even close. It is licensed out and used by many of the world's largest banks, insurers, pension funds, and asset managers, including, and this is the key part, some of their direct competitors.
So what does that mean in practice?
Well, when a major insurer or a sovereign wealth fund uses Aladdin, BlackRock, while remaining totally separate, gains this profound, real-time, aggregated view of the entire global financial system's risk profile. They can see where leverage is building up, where correlated risks are concentrated, and how different market shocks might cascade across the globe.
It gives them a kind of foresight, an informational advantage that no other asset manager has.
Exactly. It's a visibility that transforms them from just an investor into an essential piece of financial plumbing for the whole world.
So that's the engine. Let's just briefly frame the physical and legal structure of the company. They're headquartered in New York City, but their footprint is absolutely global. 70 offices in 30 countries, clients in 100 countries, and over 21,000 employees.
That's right. And when you look at who actually owns this financial giant, the structure just reinforces the concentration of power we're talking about. Over 80% of BlackRock is owned by other institutional investors.
So its management is really beholden to other massive financial entities. And you see a concentration right at the top. As of mid-2024, the top 10 shareholders hold over 36% of the total shares.
And who's on that list?
The largest shareholders are names you'd expect: the Vanguard Group, State Street Corporation, Singapore's Sovereign Wealth Fund, Temasek Holdings, Bank of America.
And this brings us to a really key concept for understanding the Big Four: recursive ownership.
Meaning?
Well, Vanguard is the largest external shareholder of BlackRock. And BlackRock, in turn, is a major shareholder in Vanguard's parent company through various mandates. They own each other.
So that raises a really important question, doesn't it? If these massive index fund managers own each other, does that mean they're less likely to compete aggressively on things like fees, or are they, in effect, a unified voting bloc when it comes to corporate governance across the S&P 500?
It creates this fascinating equilibrium. I mean, they're legally separate and they're commercially competitive to a degree, but their institutional cross-holdings, they sort of dampen the incentive for aggressive, market-destructive competition.
Because they all own a piece of everything.
Exactly. They are all highly sensitive to systemic risk because they own so much of the entire market, including each other. The very structure of modern index investing, in a way, inherently encourages oligopoly and stabilization rather than, cutthroat price wars.
So BlackRock built its foundation on risk management and technical dominance with Aladdin. In this next segment, we're going to talk about the next phase, translating that powerful foundation into global economic influence through calculated growth and, crucially, alignment with sovereign power.
Their growth trajectory is just marked by these ruthless strategic acquisitions. They're designed not just to add assets, but to acquire key competencies and market share instantly. This is growth by swallowing competitors and whole market segments.
One of the first big steps, besides some early moves like acquiring State Street Research and Management in 2004, was the 2006 merger with Merrill Lynch's Investment Managers Division, MLM.
Right. That merger significantly expanded BlackRock's retail client base and their international presence. It moved them beyond their initial focus on just institutions. But, like we said, the ultimate game changer was that 2010 acquisition of Barclays Global Investors for $13.5 billion.
That deal wasn't just huge in terms of money. It was massive in its strategic outcome. It instantly transformed them into an index fund behemoth because it came with iShares. Can we just dwell for a moment on the genius of that move?
Oh, absolutely. Before 2010, BlackRock was a strong active manager with a growing passive arm. BGI was the pioneer, the market leader in ETFs. By buying BGI, BlackRock basically bought the future of passive investment.
They didn't have to spend a decade building it themselves.
They bought a turnkey dominant global platform that was scalable to infinity. This acquisition is why they are where they are today. It was a high risk, but incredibly high reward bet on the long-term trend of indexing.
And their M&A strategy didn't stop there. They continued to expand into technology and alternative assets. In 2015, they bought Future Advisor, which is a digital wealth management provider. They integrated that robo-advisory right into their BlackRock Solutions division.
Which showed they were getting serious about serving the mass affluent market with digital tools.
Right. And then in 2019, just before the market chaos of COVID, they acquired eFront for $1.3 billion.
Yeah.
That company specialized in alternative investment management software.
And that signaled their intent to go much deeper into private equity, real estate, hedge funds, all the less liquid, higher fee private markets that traditional index funds just don't touch.
Okay, so this is where the conversation shifts a bit, from financial strategy to public power. Their strategic growth positioned them as this indispensable financial surgeon for the U.S. government during moments of deep crisis.
This advisory role is what truly separates BlackRock from the other members of the Big Four. They are the de facto financial SWAT team. They get called upon repeatedly when the financial system is melting down.
So let's go back to the 2008 crisis. In May 2009, BlackRock Solutions, powered by Aladdin, was retained by the U.S. Treasury Department.
And their job, their highly sensitive job, was to analyze, unwind, and put a price on the truly toxic assets held by institutions like Bear Stearns, AIG, and Freddie Mac. And on top of that, the Federal Reserve allowed BlackRock to superintend the $130 billion debt settlement for Bear Stearns and AIG.
Just think about that operational role. No other private company was entrusted with that level of access and responsibility.
They were literally using their risk models to determine the fair value of assets that threatened to collapse the global banking system. They had the keys to the distressed asset kingdom.
And then fast forward just over a decade to the 2020 COVID crisis, and that relationship just solidified even further, and it sparked even more controversy.
It did. The Fed, facing a complete liquidity freeze in the corporate bond market, chose BlackRock again. This time to manage two massive corporate bond buying programs, the primary market and secondary market corporate credit facilities.
This appointment, it's structurally interesting. I mean, the Fed needed an asset manager with the technical capacity to execute these purchases quickly and efficiently.
And BlackRock, with Aladdin's ability to assess liquidity and price risk across these massive, complex portfolios, was the natural, almost the inescapable choice. They were also tasked with buying commercial mortgage-backed securities, which essentially propped up the entire commercial real estate market.
But just because they're the natural choice, does that completely neutralize the conflict of interest? The scrutiny was immediate and intense because their own products appeared to benefit disproportionately.
Right. During the Fed's quantitative easing in 2020, BlackRock's own corporate bond ETF received $4.3 billion in new investment, far, far more than any of its competitors.
That perception of double dipping, that's a huge political liability.
Massive. BlackRock's defense was that their involvement was essential for market stability. And crucially, to try and mitigate the conflict, they publicly pledged to forego profits from the Fed's program, aside from their standard advisory fees. They also committed to returning any extra income earned on their bond ETFs from the buying program back to the Fed.
So, while they benefited indirectly from the attention and legitimacy drawn to their products during a crisis, there was a mechanism to ensure they didn't directly profit from the government contracts themselves.
It's a delicate, high-wire act of public service and private profit. And this reliance, it hasn't waned. After the 2023 U.S. banking crisis, who did they call?
BlackRock.
BlackRock was hired again to handle the sale of $114 billion in assets from the failed Signature Bank and Silicon Valley Bank. They remain the consistently chosen executor for cleaning up systemic failures.
So moving past that crisis playbook, BlackRock is now pivoting to new frontiers for growth in the 2020s. And it shows a clear strategy to diversify beyond just tracking public stock indexes.
The most monumental move, I think, has been the pivot into infrastructure. The January 2024 acquisition of Global Infrastructure Partners, GIP, for a whopping $12.5 billion paid in cash and shares, that is a massive statement.
Larry Fink has said it pretty clearly. He believes the future growth in private markets is going to be infrastructure.
And the GIP acquisition instantly positions BlackRock as a world leader in managing these hard long-term assets: pipelines, energy grids, airports, data centers, utilities. These assets offer stable, inflation-linked returns, which makes them incredibly attractive to pension funds and sovereign wealth funds.
Okay, so that's Frontier 1. Frontier 2 is cryptocurrency. BlackRock went from being, well, highly skeptical of crypto to becoming one of its most aggressive institutional champions.
It's a massive strategic shift, and it's driven by client demand and the realization that crypto assets are just becoming too important to ignore.
Their entry was decisive. In January 2024, their spot Bitcoin ETF, the iShares Bitcoin Trust, or IBIT, was approved. By May of 2024, IBIT had already become the world's largest Bitcoin fund. It accumulated nearly $20 billion in assets.
Which just illustrates the power of the BlackRock brand name in legitimizing what is, a very volatile asset class.
And they're not stopping with Bitcoin.
No. They filed for a spot Ethereum ETF in November 2023, and they launched something called BUIDL, which is their first tokenized fund on the Ethereum blockchain. Now, BUIDL invests in highly secure traditional assets, U.S. Treasury bills, but it's tokenized.
So they're embracing decentralized finance while dealing in the safest government securities available.
Yeah.
It's kind of hybridization of TradFi and crypto.
Exactly. And finally, we have to talk about their recent geographical and, I would say, political maneuver, the launch of the iShares Texas Equity ETF, TEXN, in June 2025.
On the surface, it just looks like a standard fund targeting companies headquartered in Texas.
But it's so much more than that. This is brilliant political strategy masquerading as a financial product. As we'll get into in the next segment, Texas and other Republican-led states have been the most aggressive in politically challenging BlackRock because of its ESG policy.
Right, leading to state divestments worth billions.
So by launching an ETF that specifically focuses on and invests in Texas-headquartered companies, BlackRock is trying to demonstrate its commitment to the economic success of the very jurisdictions trying to blacklist them. It's a PR and financial attempt to neutralize political opposition by literally investing in their critics' backyard.
It just shows how intertwined their investment decisions have become with the political environment. Okay, this next segment is absolutely central to BlackRock's modern identity. It's where the company's stated principles, specifically around environmental, social, and corporate governance, or ESG investing, meet this fierce internal and external resistance.
BlackRock started to actively position itself as a global leader in ESG investing around 2017. And this was a very calculated strategic move. It was designed to appeal to institutional clients, especially European pension funds, that were increasingly focused on sustainable outcomes alongside their financial returns.
And they didn't just talk the talk. They leveraged their enormous shareholder voting power to push their agenda.
That's right. We saw initiatives like them sending official letters to CEOs demanding climate action and actively backing shareholder resolutions for major climate shifts, famously at ExxonMobil in 2017. They also demanded increased gender diversity on corporate boards. They made it clear. They expected the companies they owned on behalf of their clients to address these issues.
And this all culminated in what was called the Fink shift. CEO Larry Fink's annual letters became these must-read documents. His 2020 statement that environmental sustainability would be a core investment goal, that was a watershed moment. He argued climate risk is financial risk.
But the political environment, particularly in the U.S., it shifted dramatically. ESG became a political lightning rod. And in June 2023, Fink announced he had stopped using the term ESG, saying it had become weaponized and politicized.
But even though he stepped away from the acronym, he didn't abandon the core concept, did he?
Not at all. He immediately pivoted to emphasizing his core belief in conscientious capitalism, stressing that BlackRock still guides clients interested in sustainability, just without using that now toxic brand name. The fact he had to drop the acronym itself just highlights the deep political polarization the firm now faces.
And that polarization is fueled by critics from both sides. You have those who argue BlackRock is doing too much and damaging returns, and those who argue the firm is not nearly committed enough. We should probably present both of those angles.
Let's start with the critique that challenges BlackRock's internal commitment. A former BlackRock Global Chief Investment Officer for Sustainable Investing was incredibly critical. He called ESG a dangerous placebo that harms the public interest.
A dangerous placebo. That's a powerful phrase. What was his argument?
His core argument was that financial institutions pursue ESG investing primarily because ESG products have significantly higher fees compared to your standard index funds. And those higher fees directly and immediately boost the company's profits. The incentive is financial engineering, not necessarily, planetary salvation.
And so if the return structure is better for the fund manager, they're going to push the product.
Exactly. Then on the external side, you have publications like the Wall Street Journal's editorial board criticizing BlackRock for pushing the SEC to mandate climate impact and diversity disclosures, even from private companies.
And the critique there is that imposing these mandatory disclosures, which carry reputation and litigation risks, would cause companies to actively avoid public markets altogether. They'd just opt to stay private.
Which would ultimately harm stock exchanges, reduce transparency, and paradoxically restrict the investment options available to retail investors. It's the argument that overregulation, even if it's well-intentioned, could stifle market activity.
Then you have the more specific claims of fossil washing. I saw one detailed study that found these huge discrepancies in BlackRock's offerings. It noted that only 9% out of 82 funds that were labeled as sustainable actually avoided investment in fossil fuel companies.
And that finding really speaks to the immense structural difficulty of simultaneously tracking broad market indexes, which are dominated by legacy energy companies, and fulfilling a claim of being sustainable. If you own the market, you own the energy sector. It's that simple.
And that structural reality brings us to the core contradiction that fuels so much activist anger. BlackRock's massive ongoing exposure to the very industries its ESG advocacy is supposed to be reforming.
The scale of this exposure is enormous. As of 2018, BlackRock was confirmed as the world's largest institutional investor in coal-fired power stations. They held shares worth $11 billion in 56 companies.
They also owned more oil, gas, and thermal coal reserves than any other investment manager in the world. It totaled 9.5 gigatons of potential CO2 emissions. To put that in context for you, that was equivalent to 30% of total energy-related emissions from 2017.
So if BlackRock is truly committed to the energy transition, those numbers show the immense inertia they have to overcome. And this provoked these aggressive activist responses. It resulted in the BlackRock's Big Problem campaign.
And environmental groups didn't just, write letters. They engaged in physical protest, street theater. I read that activists even rushed the company's Paris offices.
They did, accusing BlackRock of being the single biggest driver of climate destruction on the planet because of its holdings.
So under all this pressure, and aligned with Fink's 2020 commitments, BlackRock did make some changes. They announced the sale of $500 million worth of coal-related assets and created specific fossil fuel-free funds. But the paradox, it remains deeply entrenched.
To illustrate that duality perfectly, just consider a major appointment in July of 2023. BlackRock appointed Amin H. Nasser, the CEO of Saudi Aramco, the world's largest oil company, to its board of directors.
Wait, so they are demanding climate action and divestment from some companies while installing the leader of the world's largest oil company onto their own leadership team?
Yes,
That is the ultimate definition of cognitive dissonance in their public identity.
it absolutely is. It signals that while the firm acknowledges the need to manage climate risk for clients who want it, they simultaneously recognize the indispensable short to medium-term power and financial performance of legacy energy giants. They need that expertise at the highest level of their own governance.
And this internal tension, it fed directly into the external, highly political ESG backlash across the United States. It basically transformed ESG into a political football.
Yes, and this led to significant consequences for BlackRock in state capitals. Several U.S. states began refusing to do business with them, arguing that the firm's ESG policies were prioritizing social agendas over their fiduciary duty, which would ultimately harm investor interests.
And we saw concrete, large-scale financial actions. West Virginia, Louisiana, Florida, they divested combined totals exceeding $2.79 billion.
Right. Louisiana removed $794 million, and Florida, a massive $2 billion, specifically citing BlackRock's woke environmental agenda.
So how did BlackRock respond?
Their public response was robust. They argued that these state actions were just political grandstanding, that they put politics over investor interests, and risked lower returns for state pensions simply to make an ideological point. This political pressure, though, it forced BlackRock to innovate its approach to shareholder voting.
Right. This led to the creation of the Voting Choice Program, launched between 2021 and 2022. Can you explain this program? It's a bit complex.
The Voting Choice Program is designed to allow clients-first institutional investors and now retail investors in the massive iShares Core S&P 500 ETF to select specific voting policies for the shares held in their index funds.
So instead of BlackRock Investment Stewardship voting on all the shares, the client can choose a mandate.
Precisely. You can choose policies that range from simply mirroring what management recommends to prioritizing specific ESG factors or even selecting a Catholic values mandate that's designed to avoid sin stocks. It's an attempt to democratize proxy voting and deflect criticism that BlackRock is forcing its own political agenda on everyone.
But the criticism of this program, I think the Wall Street Journal called it a false voting choice, is pretty compelling. How is the choice false?
Well, it's considered a false choice because nearly all of the pre-selected voting options are still devised by major established proxy advisories like Glass Lewis and institutional shareholder services. You might get to choose the flavor, but the ingredients and the overall preparation, the underlying principles of the voting recommendations, are still coming from an ecosystem that is, broadly ESG aligned.
So it gives the appearance of choice, without truly changing the fundamental influence structure of corporate governance.
That's the argument, yes.
We've mapped BlackRock's scale, its technology, and its central role in the domestic ESG and climate fight. Now we need to turn to its influence on a truly global stage, starting with the major market where its strategy has faced its fiercest national security criticism.
China. BlackRock's strategy has involved an incredibly aggressive market entry into China, a move that many critics see as directly conflicting with the geopolitical interests of the U.S. and its allies.
And this market penetration was highly symbolic. In August of 2020, BlackRock received approval to set up a mutual fund business in China. That made it the first foreign-owned company allowed a wholly owned business in that specific sector,
which gave them direct access to the massive Chinese domestic savings market. And the pushback was immediate, and it came from high places. The renowned financier George Soros publicly described BlackRock's initiative as a tragic mistake. He argued it would damage the national security interests of the U.S. and other democracies.
So what specifically were those national security interests that he thought were at risk?
The concerns centered on capital flowing from U.S. institutional and retirement investors, managed by BlackRock, into companies connected to the Chinese government's military and its human rights apparatus. The scrutiny really intensified when it was revealed that BlackRock had invested client money in companies that were blacklisted by the U.S. government for human rights abuses against Uyghurs in Xinjiang and for ties to the People's Liberation Army.
A 2024 House committee report substantiated those claims, right? It found that BlackRock's index inclusion and fund investments had directed at least $1.9 billion into these blacklisted entities.
Yes. And while BlackRock correctly pointed out that this activity was legal at the time and complied with their client mandates, the perception remains incredibly damaging. It creates the impression that U.S. retirement money is inadvertently funding geopolitical rivals or ethically problematic enterprises. And it's prompted ongoing scrutiny from state attorneys general about inadequate disclosure to investors.
This immense global footprint brings us right back to the concentration of power fueled by their size. When you hear someone like Senator Elizabeth Warren suggest that BlackRock should be designated as too big to fail and regulated like a systematically important financial institution, she's speaking to a fundamental economic risk.
Absolutely. The AUM equivalent to most of the U.S. GDP inherently introduces systemic risk. If BlackRock were to face a catastrophic failure, say from a bug in Aladdin or a massive liquidity crisis, the financial contagion would be immediate and global.
But the more subtle, ongoing concern is the concept of common ownership, which affects competition even in normal market conditions. Let's try to explain this mechanism simply for everyone.
Common ownership occurs when the big three index fund managers, BlackRock, Vanguard, and State Street, are simultaneously the top shareholders in many competing publicly traded companies within the same industry.
So let's use a concrete hypothetical example from the research. If BlackRock owns, say, an 8% stake in American Airlines and an 8% stake in Delta Airlines, how does that change their incentive to engage in a fair war or compete aggressively on price?
Well, the research suggests that BlackRock's incentive, acting as a steward for its clients across the whole market, is to maximize the combined value of all their airline holdings, not just one.
Ah.
Aggressive competition between American and Delta might lead to lower prices, which are great for consumers, but it damages the profits of both companies. Since BlackRock holds a big chunk of both, it prefers stability and high pricing over fierce competition that, cannibalizes profits.
And that reduction in competitive incentive, even if it's just achieved passively through this shared ownership, has been linked to potential harm for consumers and higher CEO pay across various industries.
What's really fascinating is BlackRock's evolution on this point. They initially dismissed the economic mechanism as vague and implausible in one of their internal white papers. However, the regulatory environment is starting to catch up.
How so?
By 2023, their own SEC annual report had a major shift in tone. BlackRock explicitly identified common ownership as a potential business risk. They noted that new FTC and Department of Justice merger guidelines now recognize that common ownership may reduce competitive incentives.
So that's basically a tacit admission that regulators are beginning to view their structure as an anti-competitive risk.
It is. BlackRock warned its shareholders that this regulatory scrutiny could adversely affect the firm through investigations and increase difficulty in getting mergers and acquisitions approved. They are acknowledging that the sheer scope of their ownership is now a regulatory liability.
When an institution operates with this much scale, this much complexity, and this sort of structural opacity, it inevitably attracts a shadow industry of misinformation. I think it's important for you to understand that BlackRock's complexity often fuels various conspiracy theories.
Absolutely. When the real mechanisms of power like Aladdin's data visibility or the intricacies of proxy voting are difficult for the average person to grasp, people tend to fill that informational void with simpler, often more dramatic narratives.
A couple of specific examples of debunked claims would be the assertion that BlackRock owns both Fox News and Dominion voting systems, giving them control over media and election infrastructure at the same time.
Right. And while BlackRock does own a 15% stake in Fox Corporation, as an institutional investor holding shares for its clients, sources confirm they have no participation whatsoever in Dominion voting systems. These claims often conflate institutional ownership with operational control, which is a common error when we're dealing with index funds.
And unfortunately, these theories can quickly descend into some deeply problematic territory. We have to note the presence of anti-Semitic theories, things linking BlackRock executives to a global cabal that's responsible for manufacturing the COVID agenda.
And addressing these theories is necessary because it underscores a key takeaway. The actual measured influence of BlackRock, its $12.5 trillion in AUM, its role in government crises, its proxy voting power, is profound enough on its own without needing any fictional embellishment. The real challenge is understanding the legal and systemic power they hold in plain sight.
So what does this all mean? Our deep dive really reveals BlackRock's dual identity. It is a company built on this rigorous, pioneering risk management software Aladdin, which grew into the world's largest asset manager through ruthless strategic acquisitions like iShares and the recent monumental purchase of Global Infrastructure Partners.
But that sheer scale and influence mean there's simultaneous pushes into volatile crypto products, highly regulated infrastructure, and controversial Chinese markets, all while maintaining these deep financial ties to fossil fuels, makes BlackRock an unavoidable lightning rod for global political and economic debate.
I think the essential lesson here for you is the critical difference between ownership and stewardship. BlackRock consistently argues that its clients, the institutional investors, the pension funds, you, the retail ETF holder, are the true owners of the shares and assets. BlackRock is just the fiduciary agent.
However, BlackRock exercises the crucial shareholder votes on their behalf through BlackRock Investment Stewardship. This agency and corporate governance, combined with its indispensable advisory role during massive global financial crises, from pricing toxic assets in 2008 to steering recovery funds in 2020 and selling off failed bank assets in 2023, it places BlackRock in a unique and utterly unprecedented position.
It operates in times of crisis as an arm of the state.
But it remains fundamentally a private, profit-seeking entity beholden to its shareholders.
And that structural reality, where a private financial actor becomes a critical piece of national and global stability, leads us to our final provocative thought for you. If BlackRock acts as an arm of the state during emergency steering recovery funds for nations like Ukraine, advising the U.S. Federal Reserve, selling off failed bank assets, but remains accountable solely to its private shareholders, are we comfortable with the fact that its ultimate accountability remains financial, not civic? What regulatory framework should govern an entity that is functionally indispensable to the global economy, yet operates entirely outside of traditional bank regulation?